Talking about retirement can be a very scary subject. And I think it becomes a scary subject for a couple of different reasons. And the first one being is there are so many different types of accounts, right? And because there are so many different types of accounts, it begins to feel overwhelming. And we don't know if we qualify, which one should we be in, who knows, right? And so we kind of bury in our head in the sand and we hope for the best. And another reason is just there's that, I think, innate fear in a lot of us that when it's time to retire, there's just not going to be enough money. I mean, how many people have we heard say, or maybe even we've said, well, I'll work until the day that I die. So what I wanted to do today was just kind of talk about some of the different types of retirement accounts. We're going to talk a little bit more in depth about a couple of specific ones, and just kind of maybe take away some of the fear and the feeling of being overwhelmed on the subject, and maybe make it a little bit more palatable. So we're going to start by talking about the ones that I'm not going to talk about, just because when we get into SEP IRAs, simple IRAs, inherited IRAs, these are much more niche and specific, and they really matter for certain people, and it's just not a mass subject. So if you have any questions about any of those, if you are a business owner, you definitely need to know about SEP and simple IRAs for yourself more than anything, and it can be a real benefit for your employees as well. So keep that in mind. Park it. If you inherit an IRA, please speak with the person that is the custodian of that IRA, because there are some very specific rules that you're going to have to follow on that as well. But that's kind of all we're going to say on that part of the subject today. What I really wanted to dive into was on traditional and Roth IRAs. And these are it's the most common types of retirement accounts. It's right up there with our 401ks. And so again, we're going to make a couple of assumptions in today's videos like I do in all of them. And for today's assumption, we're going to just baseline assume that you qualify for these types of accounts. Now, depending on your age, depending on how much earned income you have, depending on what your adjusted gross income is, if you can contribute through an employer, some of those types of things impact how much or if we're able to contribute to these accounts at all. And so because of that, please speak to your tax advisor, and just say, hey, I wanted to make a contribution to this type of account. I want to know if I qualify. And if you are comfortable doing that with them, please, you're welcome to give me a call. I include our phone number at the end of every single video. I'm more than happy to help you along the process. So in that traditional IRA, if you're under the age of 50 in 2026, you can contribute up to $7,500 into that account. So what's that look like, right? You've got your paycheck, your W-2, from your employer, and you can take up to $7,500. You put it into a traditional IRA account, and you don't pay any tax on that money in the year that you earned it. That's a win. The money that it makes inside the account, you don't pay any tax on. That's a win. The downside is when you take it out, you're going to pay tax on all of it, right? The IRS is always going to get there sooner or later. So that is one thing to keep in mind with the traditional account. Also, with a traditional IRA account, there's something called a required minimum distribution. Based off of your current age, the IRS has a chart, and it says based on this age, you are required to start taking money out of your IRA account. And then there's a formula that determines how much you have to take out. So let's say you're doing great, your house is paid off, you're fine living on the Social Security check that you get. The IRS is going to still make you take money out of your traditional IRA account. And with that is going to come tax. So keep that in mind for anybody that set aside everything into a traditional IRA. You're going to start to pay tax on it in your lifetime. And its cousin, the Roth IRA, is kind of the rebel. right? And so here's how the Roth IRA works. Um, Same exact scenario, right? You go to work, you got your paycheck, you get your W-2, and you put that same $7,500 into your Roth IRA account. You are going to pay tax on that still in the year that you made that money. That's a bummer, right? The good news is anything that it makes while it's inside that account, you don't pay any tax on. So it's identical to the traditional IRA. Where it deviates is when you retire, you only have to pay tax on the portion that made money while it sat in that account, right? So only your investment earnings is the only part that you have to pay any tax on. So that ends up more beneficial for some folks at the age of retirement because it's not producing more taxable income or a significant amount of taxable income when they retire. Also, with a Roth IRA, there is not a required minimum distribution. So you don't have that albatross maybe down the line waiting for you. So a lot of people like that. A lot of people like the ability to not pay tax now and defer it down the road. My point is, there's not a right answer, right? I'm not saying, yes, you should do this or you should do that. What I am saying is each of them makes sense for different people, and both make sense for almost everybody to have some in each. It's all dependent on your situation, obviously. So please talk with your financial advisor, with your tax professional. Put together a solid plan. I promise you, even if you feel overwhelmed or scared now, it is well worth it so that you can retire, not have to pay a whole bunch of money to Uncle Sam when you do, and have enough to be able to enjoy some twilight years in your life, right? If you have any questions, please give me a call here at the office. I'm at Advantage Tax and Accounting in Newburgh, Indiana. Our phone number is 812-490-9600, and together we have the advantage.